Oh, the Bernie Madoff Ponzi scandal, the allegations of insider trading at the Galleon hedge fund. Those are just some of the headlines that have individual investors wondering how they know the people who are entrusted to invest their money, if they in fact are working in their best interest. Well, the answer lies in transparency. Here with more is Louis Day, managing partner at NS Capital in Stamford. Lou, good having you back on the program.
Thank you.
I think the individual investor is so overwhelmed if they're given any kind of information having to do with a single fund, much less an entire portfolio. Why is it becoming increasingly opaque? Forget about transparency.
Well, you know, it always has been opaque, and it's getting more complex. I mean, investing, it's a global economy, it's a global world, so everything is getting more complex and more difficult. So what we're trying to encourage investors to do is to get back to some fundamentals and to ask some very, very important questions that they can understand the questions, number one, and they can understand the answers. And the important thing is that they get these answers. And if they get the answers to some very fundamental questions, that will put them in a better position as it relates to transparency.
All right, let's take a look at a list of some of those questions. Sure. So in other words, when you go in to sit down with a financial advisor,
exactly.
What are the fees? What is the standard of care? What are the conflicts of interest, if any, and is there alignment of interest? So let's break those down. What are the fees? Because there are so many hidden fees today.
Yes, I mean the issue on the fee situation is basically that there are multiple fees. I mean the Wall Street, you know, the financial services industry will nickel and dime you to death. Okay, and David Swenson from Yale, he said, you know, you can dive 1,000 cuts your performance if you don't pay attention to the fees and costs, okay, as it relates to your investing. So what you want to know is, you want to know, number one, how is the advisor, okay, or the asset manager being paid? Are they being paid on a commission? Are they being paid for an asset-based fee? Or are they being paid as a retainer? So that's one component of the fee. The other component is you have to analyze the transaction costs. If you're using asset management or a managed portfolio, how fast that portfolio turns over on a yearly basis can have a significant impact on the cost of that fund.
So would a red flag be an actively managed fund? Would you want to stay away from that? Or is that the ability to take advantage of volatility and therefore make more money, and maybe is sometimes a more stagnant market?
That's the how, okay? The issue is there are really two markets, okay, that people invest in. We think of it as one, but it's actually two. One is very efficient and one is very inefficient, okay? And the keys to opportunity are to use active management in the inefficient market, because inefficiencies create opportunities.
When you say for the individual investor at home, when you say an inefficient market, what does that mean?
Well, let's go to the efficient market first. That'd be easier. The efficient market is one where all the relative information on a stock or security is readily available to everyone at exactly the same time. So it's very difficult for a portfolio manager or an analyst to have any success in really predicting, okay, the movement of that security, because essentially everybody's acting on exactly the same information at precisely the same time. This is considered to be a very, very efficient market. Best example of that would be in the United States would be the S&P 500 index. Huge companies, you know, the leading company is Exxon, and then it's Walmart, then it's Chevron. These are huge companies, and basically it's very, very difficult to beat the performance of the S&P 500 index for an active manager over time. All
right, some of the other questions we go over very briefly. Standard of care. What is the standard of care? What does that mean?
It means confusion.
Which is never good.
Yeah, I mean, the issue is most people do not know this, and a lot of behind-the-scenes work is going on with the SEC now as it relates to this standard of care issue. And what it is the standard of care is who are you entrusting your money to, or who are you getting your advice from? And there are two standards of care, and most people are unaware of this. If you are working for, if you're getting advice or buying products from a broker-dealer, okay, you're dealing with a registered representative. So irrespective of what the business card says, whether it's advisor or investment consultant, et cetera, it's basically a registered rep, and they are held to a suitability standard of care. And what that means is if I'm making a recommendation to you, I'm going to be held liable legally based on whether or not that recommendation is deemed suitable. So if you were a grandmother and I was recommending an internet company in China, okay, that would probably not be suitable. But you know, if I was recommending a large cap stock, whether it was a good or bad recommendation, there's very little recourse. Okay, and this is the standard of care. This is the registered rep. On the other side, there's registered investment advisors that are held to a fiduciary standard. The idea being that they're supposed to put the interests of their clients, okay, ahead of their own. And they're supposed to divulge all conflicts of interest, they're supposed to divulge all fees, et cetera, et cetera. And what's being negotiated now in the SEC is why is not the fiduciary standard a uniform standard of care.
We'll talk a little bit more about that. We're going to take a break at this point. We're going to be back with more of our conversation with Lou Day from NS Capital in Stanford in just a moment. You bring up great points.
Well,
Well, we're back talking about some of the core principles of successful investing, and that includes understanding the business of managing money and how that could cut into your profits. Here to explain more is Lou Day, Managing Director of NS Capital in Stanford. We were talking a moment ago about asking the person who might potentially manage your money a series of questions, and you brought up conflicts of interest. That it really does play into this understanding the business of managing money, doesn't it?
Yeah, it certainly does. I mean, so we talked about fees, we talked about the standard of care, and the big one today is conflicts of interest. I mean, so I have a couple of examples. Here's a prospectus, a summary prospectus. It's 12 pages long. Very acceptable document.
Digestible.
I mean, that's reasonable. That's digestible. The problem is there's really nothing in it.
Okay.
So the issue is if you want to find out about a conflict of interest for this particular fund, what you have to do is you have to pull out another part of the prospectus, which is the summary of additional information.
Okay.
And this is 125 pages long.
A little bit harder to get through.
A little harder to get through, and it's not that you can get through it. I'm not saying that. Nobody's going to get through this document. It's a legal document. It's a language. But in this is all the conflicts of interest that exist. I mean, for example, in a mutual fund, there are 10 different share classes. It's like alphabet soup. There's A, B, C, D, N, S, L, F. I can go on and on and on. And each share class extracts fees in a different way.
So is there one that, for an individual investor, is there one you want to be in?
I think, I would always say you want to lean toward an iShare, which is called an institutional share class. And obviously, because it's an institutional share class, institutions don't pay the same fees that retail investors pay.
Okay, that's a good tip.
And it doesn't have any of the embedded 12B1 fees or any of the hidden costs, that are distribution fees embedded in it. So if you can get an iShare, always go with an iShare.
All right, but it can get far more complicated.
It gets far more complicated than that, because the issue really is basically there are all kinds of pay-to-play arrangements that exist between manufacturers and distributors. In many ways, it's almost a cartel. Big mutual fund companies are paying brokerage firms commissions, for the trades that they make, and in turn, the brokerage firms are basically distributing the mutual funds, and selling the mutual funds off their platforms. So, no amount of regulation is going to change that relationship.
Yeah, that relationship that's there, but it goes even more in depth.
Oh well, I mean, the idea is it gets worse and worse. If I take a variable annuity,
this is just for one variable annuity?
This is one variable annuity. And the impact of that, this is over 1,000 pages long.
The people who wrote it don't even remember what's in it.
The thing to remember, well, I can guarantee you that I can give this to 95% of the attorneys couldn't read this and understand it, as well.
I feel like I'm with Congress.
But there's a good rule called the Munger rule. And that's from Charlie Munger. And Charlie Munger is Warren Buffett's long-term partner. He's been around forever and ever. And Charlie Munger, the Munger rule is this: if you have a prospectus, if you have a document that's more than 100 pages long, all right, and there's a commission involved, don't invest.
That's a very good tip.
And what he said, over time, you're going to miss out on some good opportunities, for sure. But in the large, over time, you're going to come out well ahead.
Because you're not going to be nickel and dimed?
Well, you're not. The reason that these documents exist in the size, that they exist, is they're disclosing things in legalese, okay, that are not good.
They don't want you to know
Okay,
about.
that they don't want you to know about.
All right, we have another
essentially.
graphic we want to show people at home, and this has to do with stockholder versus investor. Explain to us, this is the yield that you get after a five-year period.
Well, I'll hold up on the slide for a second. The issue is there are two sides to the asset management business. On the one side, okay, there is the profession, and the other side there is the business. So what everyone should try to understand is that on the side of the profession, what you're doing is you're hiring people to manage your money. Their goal is basically to put together the best portfolio possible to achieve long-term, successful returns. Mm-hmm. On the business side of investing, okay, this is now a different category. The goal is to gather as many assets as possible in order to generate fees for the company, okay, as well as the shareholders. And nowhere is that more endemic than in the mutual fund business today. I mean, the mutual fund industry is dominated by 50 companies. 90% of them are public companies. And what you see,
let's go back to that. So let's say, for example, we look at BlackRock and we see 30% or almost 31%.
Yeah, and this is an article. I mean, basically, what this shows you is the stock for these major public companies has performed a lot better than the underlying mutual funds that clients invest in. Okay, and that's really what this is showing you. And this is, we picked three, but there's an article. This article appears in the Wall Street Journal every 4 months. Okay, where they'll pick a public company, they'll show how the stock has performed, and then they'll show how the underlying funds have not performed.
And back to your point about fees, we have a graph that indicates really how fees can eat into your profits.
Well, it's very, very significant. This just shows an 8% return on $100,000. All
right, the blue line is
the top line. Okay, and that's an 8% return. Okay, and then what it shows is what that return looks like when you subtract 2% in fees.
And there you go, a real decline there.
This case, it went from, I think, 432 down to 330. So
wow.
It's a 30% impact on your returns over time.
We have just scratched the surface here. Lou, always good to have you in the program. I'll have to bring you back so we can dig a little deeper.
Okay.
All right.
Thank you, Becky.
And that's all for this week. We'll see you next week on 12 on the Money. I'm Rebecca Saran.